Good morning, and welcome to TOITOI Japan Market Radio for Wednesday, November 26, 2025. I'm your host here in Tokyo, and this is your daily briefing designed for global investors tracking Japanese equities, foreign exchange, and fixed income. Let's dive straight into today's session.
Thanks for having me. We saw a solid risk-on session across Japanese equities today. The Nikkei 225 closed at 49,559.07, up 1.849%, while the TOPIX gained 1.999% to finish at 3,520. Smaller caps showed even more strength. The Mothers Index jumped 2.701% to 2091. J-Rights were more subdued, rising just 0.488% to 2059.0. On the currency side, dollar-yen traded at 156.343, down 0.38%, so we saw modest yen strength despite the equity rally. Gold in yen terms edged up 0.161% to 15,515, while crude oil declined 1.666% to 57.86.
So a broad-based equity rally, but interestingly the yen firmed a bit against the dollar. That currency dynamic is actually tied to our first headline today. Reuters is reporting that the yen slid in broader trading despite ongoing talk of potential Bank of Japan rate hikes, while sterling showed choppiness following UK financial forecasts. It's a bit of a puzzle. Rate hike expectations would normally support a currency. What's your read on this disconnect?
It's a classic case of market expectations running up against broader macro forces. Yes, there's chatter about the BOJ possibly hiking rates, but the market clearly isn't convinced that any move will be aggressive or imminent enough to materially shift the rate differential with other major currencies. What we're likely seeing is global factors, particularly US rate dynamics and risk sentiment, dominating yen pricing. The carry trade dynamics are still very much in play. When you have the Fed holding rates significantly higher than the BOJ, even talk of a 10 or 15 basis point hike in Japan doesn't really close that gap. So the yen remains under structural pressure.
And what does that mean for Japanese equities and the broader market complex?
For equities, a weaker yen is generally supportive, especially for the export-heavy names in the Nikkei 225. Auto manufacturers, electronics firms, and machinery exporters all benefit from improved competitiveness abroad and favorable earnings translation when they repatriate overseas profits. That's part of what drove today's rally. However, there's a risk here. If the yen continues to weaken sharply despite rate hike talk, it could actually force the BOJ's hand toward faster or larger tightening, which would introduce equity volatility. On the JGB side, we'd expect yields to edge higher on credible tightening talk, but weak yen signals may also reflect soft domestic demand expectations, which could cap that upside. It's a delicate balance.
Staying with market drivers today, we're seeing another theme emerge around U.S. Federal Reserve policy. Business Today Malaysia reports that Tokyo stocks ended higher specifically on hopes for Fed rate cuts. So we've got BOJ tightening talk on one side and Fed easing expectations on the other. How do you square those two narratives?
It's actually the divergence between the two that's critical for Japan. If the Fed does pivot toward rate cuts while the BOJ maintains its gradual tightening bias, or even just stays on hold, we could see the interest rate differential narrow. That has several implications. First, it reduces the opportunity cost of the yen carry trade, where investors borrow in yen to invest in higher-yielding dollar assets. If U.S. rates fall, that trade becomes less attractive, which could lead to unwinding and actually support the yen. Second, a dovish Fed typically boosts global risk appetite, which is positive for Japanese equities as part of broader emerging market and Asia allocation flows. Third, Japanese exporters could face a double-edged sword. A weaker dollar would improve their price competitiveness, but if the yen strengthens too much, it erodes profit margins.
So today's equity gains are riding that risk-on sentiment from Fed rate cut optimism. What's your outlook for the Nikkei and TOPIX if this Fed pivot actually materializes?
Near term, I'd say the bias is to the upside for Japanese equities. Lower U.S. rates typically correlate with a more accommodative global liquidity environment, and Japan tends to benefit from that. The Nikkei 225 and TOPIX would likely see continued support, particularly in sectors that are sensitive to global growth, think industrials, technology, and materials. However, we need to watch the yen closely. If dollar-yen moves sharply lower on Fed rate cut expectations, that could compress earnings for the big multinationals, which would weigh on the index. On JGBs, we'd expect yields to face downward pressure as global yields decline and safe haven demand potentially increases if there's uncertainty around why the Fed is cutting. Is it preemptive or reactive to deteriorating growth?
On the policy side, we're also seeing coverage from bar chart noting that U.S. stock index futures gained on Fed rate cut optimism, with key U.S. economic data on tap that could influence the direction of monetary policy. Does the timing of upcoming data releases matter for how you position in Japanese assets right now?
Absolutely. The U.S. data calendar is critical because it will either confirm or challenge the rate cut narrative. If we get softer inflation prints or weaker growth data, that validates the dovish Fed pricing and you'd expect the themes we just discussed to accelerate: more risk on in equities, potential yen appreciation, and lower yields. But if the data comes in hotter than expected, the market could quickly reprice, pushing U.S. yields back up and re-widening the differential with Japan. That would support the dollar, weaken the yen, and give another leg up to Japanese exporters. For positioning, I think you want to be tactical here. Overweight Japanese equities with a tilt toward domestic demand and quality defensives that are less sensitive to currency swings, while keeping an eye on how dollar-yen reacts to the data.
Let's talk about the implications for BOJ policy in this context. If the Fed is easing and the yen faces appreciation pressure from carry trade unwinding, does that give the BOJ more room to stay accommodative, or does it complicate their exit strategy?
It's a bit of both. On one hand, if the Fed is cutting rates and the yen strengthens, that takes some of the political and inflationary pressure off the BOJ. There's less imported inflation from a weak yen, and domestic price stability improves. That could allow the BOJ to move more slowly on rate hikes. On the other hand, if the yen strengthens too quickly, it threatens the export sector's competitiveness and the inflation target the BOJ has worked so hard to achieve. Remember, the BOJ wants inflation sustainably around 2%, and a strong yen is disinflationary. So they may actually need to signal more hawkishness to prevent excessive yen appreciation, which brings us back to the tightrope they're walking. The key monitoring point is how much the currency moves and how quickly.
Shifting back to equities for a moment, today's session showed particular strength in the Mothers Index, which tracks smaller growth companies. That index was up 2.701%, outpacing the large caps. Is that a sign of broader risk appetite, or is there something more specific happening in that part of the market?
It's primarily a risk-on signal. When you see smaller caps and growth names outperforming, it typically means investors are willing to take more risk and are looking beyond the mega-cap defensives. That's consistent with the Fed rate cut optimism we've been discussing. Lower rates are especially supportive for growth stocks because their valuations are more sensitive to discount rates. In Japan's case, the Mothers Index includes a lot of tech, biotech, and emerging business models that benefit from cheaper financing and a stronger growth outlook. However, I'd caution that this segment is also more volatile, so if the macro narrative shifts, say, the Fed stays higher for longer, you could see sharp reversals. For global investors, it's a tactical play rather than a core allocation.
Let's recap the key themes for our global investor audience today. We've got yen weakness persisting despite rate hike talk, which is supporting exporters but signaling that the market isn't convinced of aggressive BOJ tightening. Meanwhile, Fed rate cut optimism is lifting equities broadly and creating potential for carry trade unwinding that could strengthen the yen. And upcoming U.S. data will be pivotal in determining which of those narratives wins out. What's the one thing you're watching most closely over the next few sessions?
For me, it's dollar-yen and how it responds to the U.S. data. That exchange rate is the linchpin for so much of what happens in Japanese markets: equity earnings, BOJ policy space, inflation dynamics, and foreign investor flows. If we break below 155 convincingly, I think you start to see a meaningful shift in sentiment. Conversely, if we drift back toward 158 or higher, the export-led rally in equities continues and the BOJ has more breathing room. Keep an eye on that level and the Fed speakers this week.
Excellent perspective. Just to remind our listeners, nothing we've discussed today constitutes investment advice. This is market analysis and context for informational purposes. If you're a global investor tracking Japan's equity, currency, and fixed income markets, we hope this daily briefing helps you stay informed. Consider subscribing to TOITOI Japan Market Radio for updates every session. Thanks for joining us today, and we'll see you next time.
Thanks for having me.